Simplicity makes for less stress and more happiness. That's an anonymous quote, but I like it. Simplicity, less stress, more happiness. Why? Because you're not violating Occam's razor, which says the simplest way to do things is almost always the best. The more complicated the engine, the more likely it is to break down. Think about it. Einstein told us, make things as simple as possible, but not simpler. That is genius, is simplicity, and that is what I think our charts are. And as we see over and over again, they work so well for us, do they not? When we see weekly vertical crossovers, inevitably, particularly with that latest survey that we did throughout the course of this year for you, they have served us well. And it also gave me some insight into further refining that. I'll talk to you a little bit about it when we get to TLT. Also, when we get to gold, I'm doing another experiment that I want you to be part of and watch, and we'll see how that goes. If you don't have our book, it is available, 11th printing. We have just a few copies left. We'll be going into our 12th printing soon enough, but I've got a copy with your name on it, autographed, ready to go out to you. Been fulfilling orders today. Follow the link in the show notes, no matter where you are watching or listening, whether it's on a podcast, you're watching us on YouTube, or you're really smart and you have gone to the website, signed up, and receive every single day our daily reviews, once a week our weekly review and forecast. Also look in those show notes where you will see the special training that we're putting out today. We're actually going to have one today on, I guess, the coming market crash. I'm sort of debating whether I want to do one on that or inverse funds, what to do when markets crash. I'll probably put that one in the show notes tomorrow, but you need to be a subscriber to get those. And again, go to chartingwealth.com, sign up for free. It doesn't cost you anything. Put in your name, email address, and every day, as soon as we finish the show and upload it, boom, it shows up in your mailbox. And again, you'll see the link in the show notes to purchase the book. Let's keep moving through these charts. Exciting day. Lots of down movement in stocks, up movements in gold and bonds. And I just find it fascinating. Hopefully, we're slowly going to be moving out of the summertime trading zone into the fall winter soon enough. Hate the summertime trading zone. It's the worst time of year to trade, and this volatility gets me excited because that's where you got some real opportunities to jump in when it just is the summer doldrums. Things are moving back and forth and everything is just complicated. It's no fun. But when stuff starts moving and moves in good determinable patterns, that's what we like. And I'm guessing the plunge protection team probably getting a little nervous today. Who knows what secret levers they may be pulling over the next few days with a big down day on the NASDAQ 100 and the S&P 500. We jump into the S&P 500 first. This doesn't even look like a weekly chart, does it? Well, it is, and it's just a Monday. We see that things slammed over hard down. It looks like we're probably, unless we have the next 4 days of this week to be strong up movement, we're going to have a weekly vertical crossover going down when this candle's drawn at the end of the week. Derivative oscillator's negative. Price percent oscillator has rocked over. And we see a big red down candle. No wick on top, wick on the bottom down through 2.97%. It was actually lower than that. It came up a little bit, but 2.93% down for the day. A big down day. One of the biggest we've seen in a while. Go to the 2-day chart. And of course, this is a completed 2-day candle now. Quite a big down candle. Remember, we had the 2-day crossover going down back on Thursday, the 1st of August, and we see further down movement. The price percent oscillator, derivative oscillator heading down. Price movement is, of course, well below. And, we need to redraw that trend line now that we can. We will do that on the 2-day chart. And again, price movement well below the 2-day. That weekly, we'll see how the week bears out, but guessing that's probably going to cross over going down. Go to the 4-hour chart. And of course, we can see where over the last 1, 2, 3.5 days, we've only had one one bright spot, and that was Thursday afternoon for just a little while. Rest of it, hard down movement both in the morning and the afternoon on Monday. Price percent oscillator, derivative oscillator heading down strong. So what do you do right now? Will you wait and you make sure that we end up with a down week? There's plenty of time to jump in. If it's going to be strong down moves, don't catch a falling knife. Don't buy at the low point on a down move. You want to buy at the right point. And we'll talk more about those right points as we continue to move ahead. But we have to have that weekly vertical crossover going down yet, and it has not occurred because the candle isn't drawn on the weekly chart until when? The end of the week. That's why it's called the weekly chart. 2-day charts drawn at the end of 2 days like we had happen on Monday, representing Friday and Monday. So again, we'll continue to watch, see what there is to see. Now, the biggest down mover for the day, NASDAQ 100, the tech stocks down 3.53%. Again, another big candle. Looks like we're going to have a crossover going down. We see that the price percent oscillator spiked over going down. Derivative oscillators turned negative. Big red down candle. Again, doesn't look like a Monday. Looks like a Friday and a bad down week. We go to the 2-day chart, and of course, it crossed over, similar to the S&P 500 back on Thursday the 1st. And we will continue to watch and see what there is to see. We can draw this line better now that that candle's finished drawing. And again, price movement well below the 2-day trend line, spiking down on that price percent oscillator and the derivative oscillator. Go to the 4-hour chart. What do we see there? Again, lots of red down in the morning, down further in the afternoon. So again, lots of down movement. We'll just wait and see. And again, that coming market crash, is it here? Can't tell you that that's what's happening, but we will continue to watch and see what there is to see. Remember, liquidity is one of the biggest keys. In fact, I think I know what our special trainings are going to be this week. First is going to be on the coming market crash. Second is going to be on inverse funds, what to do when markets crash. Third is going to be on liquidity. Okay. So we're going to have that special training for you in the show notes about the coming market crash for subscribers today. Now, let's keep moving through. Going to go to 20-year bonds. Look just the opposite, don't they, of the NASDAQ 100 and the S&P 500. We had that weekly vertical crossover at the end of the week. You know what I did for you? Those of you who listened to the comprehensive review and forecast, I notated where things were after we did that special training this last week, looking at the successes of the weekly vertical crossovers. I went and actually found that it looked like if you got in Friday before the market closed, where we knew there was a confirmed weekly vertical crossover, you'd do pretty well. Well, I did that, folks, and I looked at the jumping in point, notated it down. 136.29 at 355. 136.29. Where are we today? Where was the high? 138. 138.39. Let's see, 138.89 ended at 138.39. So again, folks, that's $2 in a day. That's not bad. Derivative oscillators gaining upward momentum, price percent oscillators spiking up. Again, we're going to ride that practice trade out, see how it works for us. Maybe it'll work, maybe it won't. Maybe it's something we learn from, maybe it's something we learn not to do. That's why we talk to you about practice trading, developing your own schemes, your own methods, your own rules. And again, we're always happy to modify what it is we do. Our job is to have stuff that works. Our job is to make money. That is the bottom line. Make money, not be stupid. First rule of trading, don't lose money. Second rule of trading, don't forget rule number 1. If you lose money, you ain't ever going to make money. You have to make money, and that's what we want you to do with us is practice so you don't lose money. You lose money, you don't have anything left. You destroy your self-confidence. You totally change everything you ever thought you would do when you lose continually real money because you run out of it. And then you give up, go home and say, this doesn't work. That's not what we want you to do. Stick with this you will learn it. So what do we see on the 2-day chart on 20-year bonds? We see this latest 2-day candle, super strong up candle, thanks to the 1.73% gain on Monday. That is a beautiful candle. Had that crossover, in fact, we're notating that for the day on the 2-day chart. And we're going to go and note now, what does that mean now that we've concluded that we have a 2-day crossover? Those of you going by our traditional method, of course, that means that at this point you can look for a jumping in point. Sort of weird. We rarely have the 2-day crossover after the weekly. That was one reason we looked at, again, it's just a strange occurrence. I mean, you look 99 times out of 100. It's the 2-day that turns first and then the weekly, but we had that bounce off the red signal line on the weekly chart. That's what set us up for weirdness. So what do you do then at this point? Well, you're going to have to find a jumping in point. And again, one thing that you could check is to see how would things have worked if you jumped in at 355. And I'm just doing that because that gives you enough time to actually jump in. If you jumped in at 355 on Monday, the opening was 138.65. 138.65 is what it says the opening was there at the end of the day. Would that have worked for you? I don't know. We'll see. We'll see how that works. We'll also wait for a pullback on the 4-hour chart for another potential jumping in point. Those of you who don't understand where I'm going on this and what I'm talking about, you've not read the book or you've not taken enough of the training. We have 2 methods of getting into trades. One is following a weekly vertical crossover going up on the Monday after that occurs, looking at the charts either around 10:30 on the 30-minute chart or probably better on the 4-hour chart around noon. If you got a green up candle, then of course you can pull the trigger and be jumping in. The other way is after you've already had the weekly and the 2-day moving in the same direction for a while, maybe the 2 days pulled back and gotten you out of a trade and you're looking to jump back in. You need the 2-day and the weekly moving in the same direction, then the 4-hour chart to back up, that is move in the opposite direction, and then roll back in the direction of the weekly and the 2-day. That's your jumping in point when that 4-hour chart crosses over on the price percent oscillator. I want you to practice that, see that, love that, be successful with that. And you practice both those methods over and over and over again. Get good at getting in and getting out and using your trend lines, your price percent oscillator, your derivative oscillator, and your Heiken Ashi candlesticks to help you make the right moves. Now we're going from bonds to gold. What do we see going on with gold? Well, like I said before, gold was already in a confirmed move up on the weekly chart going back to the 7th of June. And it has been going up since then, except for a couple of weeks where it got shaky as far as the weekly chart goes. And of course, the price percent oscillator continued to crank up over the course of the day on Monday. Got a nice big green up candle on gold. Derivative oscillator still losing momentum. We go to the 2-day chart, and what do we see there? 2-day ended the day crossing over, going up. Very interesting there, is it not? So now we're in the category where we can look for a jumping in point on the 4-hour chart. Now again, is there the possibility at about, I don't know, 3:55 in the afternoon with this 2-day chart crossing over in the same direction as the weekly of giving us a jumping in point? I've gotten really interested with that, and I have noted that for the day. 137.82 is where gold was. We're going to pay attention to that on a practice trade, see how that works for us. Again, just experimenting, but I want you to pay attention to these things. Experiment with them yourself. Again, run these kinds of tests. See if they work. And when do they work? Do they only work in the summertime trading zone, in the fall-winter trading zone, in the transition trading zone? When do they work? Do they only work on gold? Do they only work on bonds? Do they only work on stocks? Or maybe just the NASDAQ, maybe just the S&P? That's why you keep a trader's journal. In fact, we have those worksheets available for you for free in the show notes. You can print out those PDFs. We also have them bound for you in 3-month versions that we will sell you, spiral bound, beautiful. And you can get a whole year supply at a discount. You can get 1 3-month copy at a time. Look again for the link in the show notes. You can buy that from us, or you can just print your own off for free using our PDFs. Whatever works for you, my friends. What do we see happening on the 2-day chart? Again, looks like it's crossing over. Derivative oscillator still negative. I mean, it did cross over. So we're going to go ahead and mark that as having crossed over on the 2-day chart. So now the 2-day chart is going in the same direction as the weekly. We're going to scratch off the, we're just making sure our arrow's going in the right spot. We go to the 4-hour chart. What do we see there? We see 3.5 days of decent up movement. In fact, very strong up move. We're sort of topping out about the same spot at the end of the day, but that 4-hour chart crossed over going up in the afternoon on Thursday the 1st, and of course has rocketed up since then. So we'll continue to watch and see how gold sorts itself out. Exciting times. It's exciting to see this kind of volatility, this kind of movement. Offers all sorts of opportunities for gains or losses. So we'll pay attention and learn from this as we move along. Folks, it's so good to have you with us every day. Check out the special training in your show notes for those who've subscribed at chartingwealth.com. If you're not a subscriber, go do it for free. Purchase our book, support us here. That's one way that we pay for all the bandwidth and everything else, from our texting service to the syndicator that we use for the podcast, to all the equipment, everything. Thank you so much, my friends. We appreciate your support. This does cost some money, and those of you who buy the books and are our Patreon supporters, you help show the love to us so we can keep bringing you all of this for free. Thank you for making us one of the top podcasts in the world. If you're not a subscriber to our YouTube channel, please go there and subscribe, like our videos, and also send us your comments. God bless. All the best from the whole team here at Charting Wealth World Headquarters.